So picture this. You've been with the same car insurance company for like 7 years. 7 years. No accidents, no claims. You've never even gotten a speeding ticket. Okay, maybe one, but that was years ago. And honestly, the speed limit change was poorly marked. Doesn't count. You've been a model customer. You pay your premium on time every single month. You've referred your cousin. You've stayed loyal when other companies sent you mailers promising lower rates. You figured, hey, loyalty has to count for something, right? These companies reward good customers. That's how it works. And then you get your renewal notice in the mail, and your rate went up. Not by a little, not by the inflation, sorry, what can you do kind of bump. We're talking a real, noticeable, what is happening increase on your premium. For no reason. No new claims, same car, same address, same you. And you're sitting there holding this envelope thinking, did I do something wrong? Is this a mistake? Should I call them? I've had this exact conversation with so many people. And honestly, I've kind of had it with myself. My name is Emmy, and I spend way too much time thinking about money, insurance systems, and the quietly frustrating ways that financial products are designed to benefit companies way more than they're designed to benefit you. I love pulling back the curtain on the stuff that feels personal, like a rate hike, but is actually just business. Cold, calculated, totally legal business. And what I want to talk to you about today is something that sounds simple on the surface, but is actually kind of wild when you dig into it. The loyalty penalty. The idea that being a long-term, faithful, claim-free customer of an insurance company can actually cost you more money than being a brand new customer who just walked in off the street. Yeah, I know, it sounds backwards, because it is. And by the end of this, you're going to understand exactly why it happens, how to protect yourself, and maybe most importantly, you're going to feel a lot less crazy for being frustrated about it. Because you should be frustrated. You're just frustrated at the wrong thing. Part 1. The loyalty trap is real, and it has a name. Let's start here. There's actually an industry term for what I just described. Insurers and consumer advocates call it price optimization, or more bluntly, the loyalty tax. And it's exactly what it sounds like. A quiet, gradual price increase applied to long-term customers who, based on behavioral data, are unlikely to leave. Think about that for a second. Insurance companies aren't just looking at your driving record to set your rate. They're also looking at behavioral signals, how long you've been a customer, whether you've ever shopped around, how you respond to rate increases. And if all of those signals say, this person is comfortable, this person is not going anywhere, the company has a financial incentive to nudge your premium upward. Slowly, incrementally, just enough that it doesn't trigger you to leave, but consistently enough that over 5 or 7 or 10 years, you're paying significantly more than a new customer would for identical coverage. It's a little like that thing that happens with subscription services, right? You sign up for a streaming platform at a promotional rate, and then 2 years later, you look at your bank statement and you're paying twice as much, and you genuinely cannot remember when that happened. The increases were small enough that they flew under the radar, but they added up. The difference with insurance is that the stakes are higher. We're not talking about a streaming service you can cancel in 30 seconds. We're talking about hundreds, sometimes thousands of dollars a year, and it's happening to people who are doing everything right. Now, and this is important, is this illegal? In some states, yes, actually. A number of states have regulations that prohibit insurers from explicitly using price optimization models that factor in customer retention likelihood rather than actual risk. But enforcement is patchy. The data is complex, and the companies are very, very good at making it look like your rate increase is tied to legitimate risk factors rather than your loyalty profile. So even where it's technically prohibited, it still basically happens, just dressed up differently. The takeaway here isn't to be paranoid, it's to understand the system you're operating in, because once you understand it, you can work with it instead of being quietly worked over by it. Part 2. Why insurance companies don't actually reward loyalty even when they say they do. Here's where it gets a little philosophically frustrating. Most insurance companies do have some version of a loyalty program. They call it things like loyalty discount or long-term customer benefits, or they give you some kind of diminishing deductible over time. And those things are real, they exist. But they're also kind of the oldest trick in the book. The loyalty discount is almost always smaller than the rate increase you're absorbing over that same period. It's essentially a fig leaf, a gesture of goodwill that makes you feel like you're being rewarded while the actual math is moving in the opposite direction. I like to think of it like this. Imagine a hotel that charges you a higher room rate every year you stay there, but gives you a small discount on room service. You might feel like a VIP, but you're actually paying more than the person who booked online last week through a third-party site. The loyalty perk is real, it's just not the whole picture. And here's the deeper issue. Insurance companies are in a fascinating business where new customer acquisition is extremely expensive. Getting a new customer, advertising, underwriting them, onboarding them, costs real money. A long-term customer, even one they're overcharging slightly, is actually very profitable because there are no acquisition costs. You're already there, you're already paying, you're already trusting them. So when an insurer says, "We value loyalty," what they often mean is, "We value the fact that loyal customers are low friction and high margin." That's not cynicism, that's just business, but it's worth knowing. And the cruel irony, the customers most likely to be affected by the loyalty tax are often the most conscientious ones, the people who pay on time, the people who don't call and complain, the people who aren't price sensitive in the way that, say, a young person shopping for their first policy might be. In other words, the good customers, the ones who probably deserve the break the most. Okay, so let's talk about the driving record piece, because I think there's a really common misconception here that causes a lot of frustration. People believe, reasonably, logically, that if you're a safe driver, your insurance should be cheaper. And to some extent, yes, that's true. Having accidents and violations on your record will definitely increase your rate. A DUI can basically double or triple your premium overnight. A series of at-fault accidents will mark you as high risk and cost you. But here's what people don't realize. A clean driving record is basically the floor, not a ceiling. What I mean is, being accident-free and ticket-free doesn't earn you points in some system that drives your rate down over time. It mostly just means you avoid the penalties that would drive your rate up. Once you hit clean record status, you've basically maxed out what your behavior can do for your premium. Everything else is determined by factors you may never have thought about. Your zip code, how dense the traffic is near where you live, the crime rate in your neighborhood because that affects theft and vandalism claims, the cost of auto repairs in your region, and those have gone up significantly, the number of uninsured motorists in your state, medical costs in your area, weather patterns and natural disaster history, the overall claims experience of everyone in your insurance pool. All of these things float your rate independently of how you personally drive. And this is one of the most disorienting things to realize when you're holding a rate increase notice thinking, "But I didn't do anything." You're right, you didn't. But the guy across town who had 3 fender benders last year is in the same pool, and so is the neighborhood with a spike in catalytic converter thefts, and so is the hailstorm that cost the company $40 million in claims 3 states over. You're not just paying for your risk, you're paying for everyone's risk. And that's kind of the whole premise of insurance, risk pooling, but it does mean that your individual virtue as a driver only goes so far. So what can you control? More than you think, but probably not what you've been focused on.
All right, here's the part where I stop being conceptual and get practical, because I feel like we've laid enough groundwork. The single most impactful thing most people can do for their car insurance premium is something almost nobody does regularly. Shop around, aggressively, every single year. I know, you've heard this before. Get quotes, compare rates, blah, blah. But I want to explain why this is so much more important than it sounds, and why the specific rhythm of when you do it matters enormously. Insurance companies, all of them, price their products partly based on competitive pressure. When a company is trying to grow its market share, it prices aggressively to attract new customers. When it's trying to improve profitability, it eases up on those competitive prices and leans on retention of existing customers. This cycle happens constantly, and it means that the best company for you at any given moment is a moving target. The person who shops every year, even if they don't always switch, is essentially exploiting this cycle. They're always in a position to leverage a competitor's price against their current insurer. And here's something most people don't know. Sometimes just calling your insurance company and saying, "I got a quote from a competitor for less," is enough to trigger a retention offer that brings your rate down. Insurance companies have retention teams whose entire job is to keep you from leaving. They have tools available to them that your regular customer service rep doesn't mention unless you push. I had a friend, let's call her Diane because her name is Diane, who had been with the same insurer for 11 years. Good driver, homeowner, bundled her home and auto. She got a quote from a competitor and it was about $600 a year less. She called her current insurer kind of nervously, not really expecting anything, just to cancel, and within 10 minutes she had a retention offer that matched the competitor's rate. 11 years, and they'd been overcharging her the whole time. They had the ability to charge her less, they just hadn't. That's the system. It's not malicious exactly, it's just rational. They charge what they can get away with until you push back. Now, sometimes you actually do need to switch. Sometimes the gap is too big, or the retention offer isn't good enough, or your insurer has just become genuinely uncompetitive in your area. And switching is usually way easier than people think. You get your new policy, it starts, you cancel the old one, done. Most of the anxiety around switching is just inertia dressed up as complexity. The practical move? Set a reminder every year, about 6 weeks before your renewal date, to pull quotes from at least 3 other carriers. Use comparison sites as a starting point, but also go directly to company websites, and sometimes call, because occasionally the phone quote is different from the online quote. Yes, it takes a couple of hours, but we're talking about hundreds of dollars. That's a good hourly rate.
Part 7. When to stay, when to go, and how to make the call. I don't want to leave you with the impression that switching insurers is always the right move, because it genuinely isn't. There are real reasons to stay with a company, and they're worth naming. Claims experience matters enormously. An insurer that's cheap when nothing is wrong, but terrible when you actually need them is a bad deal in a way that doesn't show up in the premium comparison. Reading reviews specifically about the claims process, how fast they pay, how they treat customers after an accident, whether they fight you on repair costs, this is some of the most valuable research you can do. Sites that aggregate verified claims reviews are genuinely useful here. Financial stability matters too. An insurer that goes belly up right when you need them is obviously a catastrophic outcome. Checking the AM Best rating of any insurer you're considering takes about 30 seconds and is worth doing. Coverage differences matter. Not all policies are equal even at the same nominal coverage levels. Rental car coverage, gap insurance if you're financing your car, new car replacement versus depreciated value. These are real differences that can show up at the worst possible moment. And honestly, sometimes the math just barely pencils out. If you're saving $80 a year by switching and the new company has mediocre claims reviews, that might not be worth it. The goal is thoughtful optimization, not reflexive switching. So here's the framework I'd suggest. Every year before renewal, pull at least 3 quotes. Compare them to your current rate. If the gap is more than 10%, call your current insurer and try for a retention discount. If they can close the gap, great. If they can't or won't, take the switch seriously. If the gap is less than 10%, factor in the claims reviews and your general satisfaction. It might still be worth staying, but at least you know what the market looks like. That knowledge is valuable even when you don't act on it. Part 8. The stuff that moves your rate that you actually can control. We've talked about what you can't control. Let's end the content section with what you actually can. Your deductible. This is the most direct lever most people have. Raising your deductible from $500 to $1,000 can lower your premium meaningfully, sometimes 10 to 20%. The math only makes sense if you have an emergency fund that can cover the higher deductible if you need it, but if you do, it's worth considering seriously. Your coverage on older vehicles. This is a big one that a lot of people overlook. If your car is worth less than 10 times your annual comprehensive and collision premium, and your car may have depreciated to that point without you realizing, carrying full collision and comprehensive coverage might not make financial sense anymore. Check your car's current market value. If it's an 8-year-old vehicle worth $6,000 and you're paying $1,200 a year in collision and comp, the math might not be there anymore. Your credit score, as I mentioned, improving it genuinely can improve your rate in most states. Completing a defensive driving course, it's boring, but it usually results in a real discount, and it's often available online. Where you park your car, this one's situational, but if you're renting a garage or have a driveway option you haven't been using, it can matter. How many miles you drive annually. If you've started working from home and your mileage has dropped significantly, reporting that to your insurer can lower your rate. Some companies have shifted to mileage-based insurance products that can be a good deal for low-mileage drivers. And, bringing it all back, shopping around. Every year, without fail, it's the highest leverage action on this entire list. Conclusion: what you actually deserve and how to get it. So, let's bring this home. You came into this video maybe feeling vaguely wronged, like the system wasn't playing fair, like you'd been doing the right things and still somehow ending up on the losing end of a financial product you're paying for every month. And I want to tell you, that feeling was accurate. You weren't being paranoid. You weren't misunderstanding something. The loyalty penalty is real. Price optimization is real. The gap between what new customers pay and what long-term customers pay is real. But here's the thing. None of this is personal. It's structural. It's the predictable result of how insurance markets work, how companies optimize for profit, and how human psychology creates inertia that companies are very good at exploiting. The moment you understand that, you can step out of the emotional frame and into a more useful one. You're not a loyal customer being betrayed, you're a consumer in a competitive market who has more power than you've been using. And that reframe matters because it moves you from passive frustration to active decision-making. It takes the sting out of shopping around. You're not being disloyal, you're being rational. It makes the phone call to your insurer feel less awkward. You're not complaining, you're negotiating, which is completely normal and expected. It makes the annual review feel less like a chore. It's a financial habit that compounds over time. I think about the people who, over a decade of driving, saved a few $1,000s just by spending a couple of hours a year on this. They didn't become insurance experts. They didn't spend their weekends reading policy fine print. They just decided that a financial product should earn their continued business, not assume it. That's the real takeaway here. Not a specific company to switch to, not a magic discount code, just the quiet, empowering decision to treat your insurance like what it is, a product you're buying, and shop for it accordingly. You've been a good driver, maybe a perfect one, and that does matter. Just know that the reward isn't going to come automatically. You're going to have to ask for it, push for it, sometimes walk toward the door to get it. But you can, and now you know exactly how. Thanks for spending time here. If this helped you think about your insurance differently, or your financial life more broadly, I'd love it if you shared it with someone who's been complaining about their renewal notice lately. Because honestly, they probably need to hear this. Take care of yourself out there.